afternoon, ladies and gentlemen, and welcome to True Potential's Week in Markets. My name's Matt Henderson. I'm one of the portfolio managers here at True Potential. I'm joined by my colleague here, Sam Elliot, and he's one of our portfolio analysts. So we've just gone through the US government shutdown, so that's the thing that's changed since last week. So government had been in shutdown for 43 days, and that's the longest ever shutdown we've had in history, Sam. And what that means for financial markets is actually we get some of the key data points that we would normally expect to see throughout the month not be released or published. That's mostly in the form of the jobs data, so the labour market data, the NFP, and also the inflation data. So those haven't been released to the market. Since the government is no longer in shutdown, we've actually had September's jobs report come through. So Sam, if you could just talk us through the numbers, what we've seen there, but also highlight the past numbers that we've seen and kind of the journey that we're on there.
Yeah, sure. Thanks, Matt. So as you say, we had the September labour data released, and it was actually really strong.
Yeah.
So it showed that there was about 120,000 jobs added to the US economy in September. That was the highest level that we've seen since April.
Yeah.
And it was more than double what economists were expecting. So a really strong print. And if you look at the 3 months before that, 2 of those months were negative. So there was job losses in 2 of those 3 months.
Yeah, so I guess markets had been looking at that and thinking, actually, is GDP growth starting to weaken because we're seeing less strength within the labour market? But I guess when we look at other indicators of GDP growth, so if we think about something like the Atlanta Fed's GDP nowcast, where effectively what we're trying to look at is looking at higher frequency data points to have a good estimate at what GDP would be for the quarter, that's tracking at about 4%. And that's real GDP. That doesn't include the inflation component. So that's really strong numbers still. So despite those kind of weaker, mixed labour market data numbers we're receiving, it hasn't actually fed through into any of the data, has it?
Yeah, that's right. And a lot of that driver of that GDP growth that we're expecting is consumer spending.
Yeah.
So some of that robustness that we saw in the jobs data in September coming through, and that consumers are still going out and spending. Also seeing positive drivers from the likes of exports and also from business spending. So that's really the AI CapEx story that we've been talking about.
Yeah. And I guess the other thing to bring out as well is that we've kind of got through this period where markets had been a little bit uncertain in terms of tariffs, but actually when we've looked at the data that's been released, we haven't really seen anything yet to indicate that tariffs have been either A, inflationary, which I think was the main initial concern of markets, that tariffs would be inflationary, but also B, it hasn't really impacted any of the GDP numbers, has it?
Yeah, that's right. We saw some front running of imports at the start of the year ahead of those tariffs, but really since then we've seen a normalization. We've seen trade deals come through with the US with various different trading partners.
Yeah. So as well, what does this mean for the Fed in terms of their next interest rate meeting, Sam?
Yeah, it's really difficult. It's obviously, like you say, they've been missing a lot of the key data which they would usually use to make that decision.
Yeah.
And they've actually cancelled the October print for the labour market data. So this September print is the last we'll see before they next meet in December.
Yeah.
Maybe the strength in that labour market data might just question whether they cut interest rates again in December, just given the strength of labour markets there.
Yeah, and I guess, though, when we're looking at what market expectations are, we can still actually see the direction of travel is for more cuts rather than more hikes. So I think at the minute we're about 3, aren't we, in terms of forward expectations for further interest rate cuts from the Fed?
Yeah, it's just a case of the timing of when those come through, I think.
Yeah, perfect. So markets this week, they've been a little bit more volatile. I guess we've seen most major equity regions down roughly about 3% this week. So a little bit more negative for equities. Any comments on those, Sam?
Yeah, so like you say, we've obviously been missing a lot of the key data which market participants would look to when they're buying and selling assets. So we've seen a bit of volatility within equity markets through the course of November. That's continued again over the past week. So like you say, global equities down about 3%.
Yeah.
And that's been consistent across regions. So if you look at the likes of the US, the UK, Europe, Japan, all down roughly 2.5% to 3%. So it's been pretty consistent across the board. We have seen some of those higher valuation areas such as tech or in the consumer discretionary names such as Amazon down a little bit more than the rest of the market, just on those fears around the high valuations which those types of companies are trading on. Yeah,
but in terms of that pullback, it's more company specific and more things around the valuation where we're at the moment rather than any deterioration in the backdrop.
Yeah, so as you said, economic growth looks strong. That's feeding into company earnings at the aggregate level.
Yeah.
So like I say, company basis, where seen some comments within the earnings releases that we've had over the last couple of weeks. That's feeding into that.
Yeah, and I guess as well, inflation's kind of still within that 2 to 3%. So the macro backdrop seems to be stable and fairly similar to what it's been previously. It's more just people looking at the valuation and some of the more company-specific things. What we also think is interesting to comment upon as well, although markets have been a little bit weaker recently, if we look at year-to-date returns from global equities, they're up 17%, including the recent patch of weakness that we've had. And even if we expand that period to the past 2 years, global equities are up 38%, including this weakness. So actually, although short run it's been a bit weaker, the long run return from equities has been excellent.
Yeah, and we've seen a similar picture within gold as well. So gold's had an extraordinary year, reached new all-time highs, but just in the last month or so, it just came off the top of those highs. So it's down around 6.5% over the last month, but still at extremely high levels, just given the performance that we've seen this year.
Yeah, so year-to-date performance is about 50% for gold as well. So I guess what we're hearing from the conversations with people we speak to on a regular basis is a way to summarise what we're seeing is people actually being prudent in terms of risk management, looking just to trim back some of those positions that have performed exceptionally well. So like you're saying, US equities where the valuations have become a little bit rich, places like gold, as you've just mentioned. So really what we're seeing is people look to pull back in those places that have done well, book some profits, and then rotate to areas where they're seeing a little bit more value. So moving to Japan, emerging markets, Europe, places like that, and also looking to just build up a little bit more cash in the portfolio. So if we do see any material pullbacks in markets, they've got the opportunity to capitalise on those cheaper valuations.
Yeah, we've seen positive stories across some of those different areas as well, like of Japan having government change, Europe with increased fiscal spending, which should support the companies there as well.
Yeah, perfect. So thanks for your help today, Sam. Thank you everyone for watching, and we'll catch you in next week's episode.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.